Are you ready, Gregg? Are you ready?
I'm ready. You were frozen.
You were frozen. You were frozen on my screen first.
Well, I don't know about that.
Who do we have in here? We got John Henning in here right now. Welcome, John.
See John every watch party on Tuesdays. John's there. I appreciate it. It's been good to chat with you there in the watch parties on Tuesday nights, John.
All right, and we got Lee, we got Kath, we got people trickling in. Lee Pham is also here.
Do we have the star of the show, Lee Bishop, with us? I was just listening to the podcast with Lee. It was the release of his episode.
That's right.
You sounded great, my friend. I especially loved when we got to introduce Lee and we talked about his background and all that, and we talked about the IT, that he comes from an IT background, and then immediately we had some IT issues. That was incredible.
Mm-hmm. I think that is very telling of the IT industry.
Jake Hargrove's back. Your buddy Jake.
Jake, what's up, buddy?
I love him when he announces himself when he comes in too. Yo! Appreciate you being here, Jake.
Jake's a good dude. Jake and I we're in a gang. We met at the Capitalism Conference in Dallas, and that night, the first night, me, him, and Doug, who was on our show, all hopped on these bird scooters. I don't know if anybody's used these bird scooters, but it's like these short form, like with an app, you rent the scooter that's motorized and it goes like 12, 15 miles an hour. And we were zipping around downtown Dallas in really cold weather. My eyes were tearing up in these scooters, but we're a scooter gang. So
I'm getting a visual of like Dumb and Dumber here when like Harry and Lloyd are like this is on the interstate.
Yeah, it was like that, but separate scooters.
That's good.
Yeah. I am going live here simultaneously. Super seamless right now.
Oh man. Well, good stuff. Jake did make one note. He said alcohol was involved.
Yeah, true story.
Good stuff.
It was a networking event, and we are, guess what, Gregg? Hold on a second. We're live on Facebook right now for the Thursday edition of the Not Your Average Investor Show. Gregg, I was just telling you a second ago that today I was just like, yeah, it's Thursday. Like, I feel like we got this like awesome rhythm of Thursdays being sweet. And I've been looking forward to it all the last hour when I realized it was Thursday and we're about to do this, man. I am your co-host, Pablo Gonzalez, my incredible co-host, Gregg Cohen. Say hello to everybody, Gregg.
Hey, everybody. Happy to be here. Let me start over. I am happy to be here with you on the Not Your Average Investor Show. Did I do it all right?
That was pretty good. That was pretty good. It's definitely an improvement. Trending up. So for those of you who are joining us for the first time, Thursday is our casual, fully Q&A episode where we started a new tradition last week that we dissect a property and a deal so that it can be like a real educational moment for everybody. And it's driven by you. It's driven by your questions. It's driven by your interaction. So we want as much engagement as possible. So there's two ways to engage. And the first one is to chat with us and chat with everybody else. So for that, you just click that little chat button that's on the bottom left. And you got to do one trick. You got to hit that blue drop-down menu that says all panelists and go to all panelists and attendees. So everybody sees your valuable opinions and you can make a new friend while you're here. And then the second one is if you're going to want us to ask a question. What did I add to the top of the screen? Lee, you're messing me up, Lee. Let me get through my thing. If you're going to ask another question, go to the Q&A box and pop that open and put your questions there. And that is the easiest way for me not to short circuit and keep, is it circuit?
Carry the Niner.
That's the easiest way for me to keep track of the questions and answers, right? I am looking at the Zoom chat. I try to look at the Facebook chat, but that Q&A there, that's really front and center for me. And I'm not perfect, folks, but I do my best. And last is, if this is your first time on, or you just want like a real good primer on rental income property investing, go to jwbwebclass.com. I was just checking that I didn't mess that up. jwbwebclass.com, where Gregg has his presentation that explains to you soup to nuts the benefits of rental income properties, what to look for in a market, what to look for in a property, and everything else that JWB has been doing better than everybody else for 15 years. So, and if you have a specific question about your portfolio, about how you want to do this, if you anything that we talk about today, and you just want some one-on-one loving, go to chatwithjwb.com, schedule a time with the team, and it'll be a really, really useful use of your time. And without further ado, it's on, Gregg. You ready to dive into this property on Jasper Avenue?
Let's do it. Yeah, we thought this would be a nice way just to kind of introduce and get everybody involved. If you look, and for all of you who are regulars on the show on Thursday, we usually start with some of your questions from the previous episode on Tuesday, and we're certainly going to do that. But I think everybody can agree that last week's Thursday show was one of the best for Thursday. And I think it started because we kind of put this foundation out there of this teaching moment within looking at an available property, a turnkey property, and picking out some things that I'll pick out that you guys should take notice of. And then your questions kind of come from the real life application of it. So if that's okay with everybody, I think we start there. We'll use it as this teaching moment, and hopefully, you can fire your questions in, and we'll get all those questions answered so you see what happens in real life.
Gregg, like the Tony Romo that you always are, right? Like you kind of saved me there. I do have 4 questions from Tuesday from Marilyn, from Joseph Brown, from Rebecca Zern, from Bill. We're going to get to those as soon as we do this property eval, but we want this to be the foundational element of Thursday because it's super educational. So you ready, buddy?
Let's do it.
I'm going to share this thing.
So Pablo, why were you mad at me before we jumped on the show here, before we went live? What were you yelling at me? What were you screaming at me about?
Was I yelling?
Had to do, well, a lot of things. Had to do with our returns on this property, right?
Yeah. It had to do with our returns on this property. I saw that in this evaluation, it says 10.74% return. And I said, what the H, Gregg? You've been saying forever that you only say 7 to 9% returns. And for whatever reason, you're always showing like a 9 point something return. And now you're up to 10.74. And my head kind of exploded. Then I went back, combed it, and now we're here.
That was very well played, brother. Yes, you were upset. You called me a liar. You said, I can't mess with your emotions like that anymore. What am I doing showing us 10.74% return? And I thought this is a really important topic to discuss. Okay, why are we showing a 10.74% return? If you guys are clients of JWB, or if you've been following JWB for years now, we have been preaching 7 to 9% returns on investment, right? That has not changed. Well, now it's changing, okay? So now our return expectations have gone up, okay? Why is that happening, Pablo?
It is something that's very interesting. It is the interest rates.
Man, you are good. You're good. It's the interest rates. It's exactly what we've been talking about really since Richie joined us, 4 weeks ago on our show, right? We have been talking about why this opportunity right now to purchase and add rental properties to your portfolio is like something that I've never seen before, right? When we're talking about the value of low interest rates, being able to acquire with smart debt that stays in place for 30 years, it has such a substantial impact on the immediate cash flows and returns of your rental property and the long term. And guess what? We made the decision based on the interest rates that we're able to acquire for our clients through our network of approved lenders on every evaluation now, we're dropping that interest rate expectation. We dropped it a 0.5 point, which is a huge drop, right? And we don't give you this information. We don't give you this expectation unless we know that we can hit it, right? This isn't one of those things where we're going to put this 4% interest rate like we're showing here, and then you're going to come back with a higher interest rate. Some other turnkey companies do that just to kind of like juice their returns. We're very, very conservative with it. But a 0.5% drop prior to this week, the same property had a 4.5% expected interest rate. Now it's 4%. And that had basically a 2 percentage point increase on the return on investment for this property, which is huge, right? That is now why our evaluations of the properties that clients are purchasing now, you're going to see between 9 to 11%. returns, which is not something that I have shared. I have not set those expectations. I don't remember the last time I did. It's been years and years and years. So it's truly impactful. And I want everybody to understand that this is the deal when we're talking about it. It's the interest rates are the deal. I keep saying this, right? Rental properties are consistent. The same things I love about rental properties, the positive cash flow, the team behind it, right? The potential for long-term appreciation is the same as it was a year ago. It'll be the same in a year from now, but you're not going to have this opportunity to get interest rates at 4%, maybe even lower. In the threes are a potential, depending on how you structure your purchase. So I thought it's a really cool example of real life, how this changes and how this improves the asset that you can purchase.
Yeah, and Lee here in the question says, wow, the surprising thing to me about the property is the 1.85% return on investment for non-recourse, but I love the rent collection on 200K. Can you,
Yeah,
I don't really know what that means. So can you explain that to me?
Yeah, let's break it down. In fact, there's a lot of numbers on these sheets. And so I think sometimes it's hard for people to follow where we're saying, why don't we zoom in a little bit? And if you will zoom into that 10.74, like that box right there, the 1 point, yeah, there you go. Perfect. All right. So yeah, maybe go a little bit to the right there a little bit. Perfect. All right. So what Lee is talking about is that 1.85% return on investment. Well, let me kind of break down what you guys are seeing here. When clients purchase properties, there's basically three different ways that you can purchase. You can purchase with all cash. You can purchase using a non-recourse loan, which is when you're buying a property in your retirement account, you need a special type of loan. It's called non-recourse. And then you can purchase with conventional financing outside of your retirement account. The top section that you see there with that $996 a monthly cash flow, 5.89% return on investment, that's for a cash purchase. All right, that means you don't have a mortgage in place. The next section below is what Lee was referencing, $167 of positive cash flow each month and a 1.85% return on investment. We'll talk in a second about why that makes sense for a certain section of our clients. And then the section below is what I reference most often, and commonly people are talking about buying with conventional financing. That's where I'm saying that simply because we're able to get interest rates at 4% for clients instead of 4.5%, and we're confident enough to put that on our evaluations now, that client's estimated return on investment just jumped up about 2 points. And so now clients are going to see between 9 to 11% returns on their properties when they talk to my team and think about adding them. The cash flows have also gone up. Typical cash flow somewhere maybe around, I'm still going to be conservative and say, 200, 225, 250, but you can see here, you can get upwards of 275 and even a little bit more for a conventionally financed purchase. All right. So when you're looking at that, you're saying, Greg, well, 10.74 sounds great. 1.85, Greg, you talk all the time about earning a great return on your investment. Why would 1.85% make sense, right? And it has to do with why somebody is buying this property, okay? So buying inside your retirement account and outside of your retirement account are two completely different buying decisions. And the reason is because inside your retirement account, you don't have the same financing options. You have to go to what's called non-recourse financing. All right. Non-recourse financing is not like conventional financing. Non-recourse financing basically is a lender, a very small niche lender, not your big lenders out there. They would never do it, but a very small niche lender looks at the ability to make you a loan and they say, let's say Pablo, let's say you're going to get a non-recourse loan. They would say, all right, Pablo, I'm going to make you this loan even if I don't have recourse against you if you don't make the payments. How many banks do you think are willing to take that type of a risk, Pablo?
Small percentage.
Very small percentage. Well, so that's the deal for them. And the reason is because when you buy in your retirement accounts, there's no credit score. Your IRA, your 401k doesn't have a credit score. Pablo the individual has a credit score. And banks like to know that Pablo the individual has a credit score because if Pablo the individual wouldn't make his payments, the banks are going to wreck his credit. And they know that he doesn't want that, and that would hurt down the line, so they know that there's more of a reason Pablo's going to figure out a way to make his payments, right? Well, if there's no recourse against it, banks are fearful that they have to take back more properties, and banks don't want to do that. So in a non-recourse loan, you wipe out almost every single lender that you've ever heard of, and it's a very, very small niche lender. And what happens is it's harder and it's more expensive for that bank to acquire the funds to be able to lend out to you. All right, so your interest rates, because it's a small niche lender and their cost of goods sold goes up, your interest rate is also going to go up. All right, years in the past, I used to borrow non-recourse debt, and clients used to borrow non-recourse debt at 12% interest. And the payback terms used to be 10 years. You'd have to pay the whole loan back in 10 years. Now we've worked on that with our non-recourse providers. They're fantastic partners. We've gotten the loan interest rate down to 7.5%, and you can pay it back over 20 years. And the reason that's important, because when you have a product like that, it still meets rule number 1 of investing in rental properties. Pablo, what's rule number 1 of investing in rental properties?
Cash flow.
Cash flow. It's got to be positively cash flowing. So you got to understand the lens of why non-recourse financing makes sense. Your interest rates are going to be less advantageous because that's the only way to get financing in your retirement accounts. But it is a way for you to diversify your retirement accounts so that you're not only in the stock market, you're not only in stocks and bonds. You can now own real estate in your retirement accounts. And you still get the benefits of leverage as well. You hear a lot of us talking about how important it is, especially if you're in a growth market, to use other people's money as a way to increase your return on investment. Well, you still get the benefits of doing that. So at the end of the day, and one more point, if it's money in your retirement account, Pablo, you're a young guy, you've got money in a retirement account, right? Are you planning on touching that money tomorrow?
Nope.
No. If you got $100 a month of cash flow or $300 a month of cash flow in your retirement account, would it make any difference to you or to your life if it's in a retirement account?
Nope.
No, it wouldn't, right? The need for positive cash flow is less when it's in a retirement account because it's money that you're not touching anyways, right? The need for positive cash flow outside of a retirement account, it's much more useful because you can use it. You can pay your cell phone bill or whatever with it. You can't do that. So that is also something to take into account, that you don't need that extra cash flow as much as it's nice to have it outside of it. So you put all those things together, and that's why a 1.85% return on investment for non-recourse financing makes sense, and it's actually an asset builder for you. If I was to show you a 1.85% return on investment for conventionally financed properties, you should be calling me crazy. That's a totally different ball game and not something that you should be investing in for a rental property.
Yeah, that makes a lot of sense, because you talk about how this is, this asset class in your retirement account is competing with the money you would put into bonds, right? Like into which bonds are, do you know what bonds return these days, or?
Depends which ones. If you're buying T-bills, it's less than 1% is what you're earning. If you're buying, corporate bonds, 2.5%, maybe 3.5% returns are kind of what you're getting. But nothing like you can see for rental properties.
Sure. So you'd be at 2.5%, 3% returns, but in these valuations that you have here, these ROIs, you are just talking about strictly cash flow, debt pay down, these things, right? You're not referencing appreciation, which is historically 4.4%, 4.5%. So now would you add that
exactly
4.4 to 1.85% if it's going to be in your portfolio? I'm 39. It's going to be there for 20 years. So I can count on a market cycle. Yep. That means that now we're talking about like 6%. And that is just destroying what bonds would be doing, right? This is what I've been learning lately.
A little bit more than that. So when you're thinking about your true return on investment, including appreciation, you have to think about how much did you put down. All right. So let's keep it simple. Let's say that the average home price appreciation in Jacksonville is 4% per year. It's a little bit more than that, but let's just keep it simple. Well, in a non-recourse loan, you're putting 50% down. All right. So your return from appreciation is actually 8% per year because you only are using 50% down instead of all of your money. So 8% plus the 1.85% we have right there gets you close to 10. If you're looking at the total full potential return on investment for using a non-recourse loan in your retirement accounts. And then boom, it makes sense compared to bonds, right?
Yeah. Yeah. I mean, it makes a ton of sense compared to bonds.
Yeah.
So Mike Foster's asking, with a cash purchase out of an IRA, do you get any of the typical expense tax write-offs? If not, I assume that lowers cash flow as well.
Great question. And I think he asked, are you getting the write-offs in an IRA? Was that the question? Yes.
Correct. A cash purchase in an IRA, do you also get tax write-offs?
You do not. You do not get the tax write-offs because you already have it in your retirement accounts. So, but in our evaluations, when you look at a cash purchase, if it's in your IRA, it's easy to take out. If you're talking about your tax benefits from things like depreciation, it's easy to take that out. You're going to see basically about a 5 to 6% return, depending on if you're buying in your IRA or not, for a cash purchase.
All right. Is there anything else you want to hit on this property eval? Should I pop it back up on the screen? Should we get into the user-generated questions from Tuesday?
Let's go to the eval just to point out a few other things. I know for some folks, this is still one of the first few times you've seen one of the evaluations for a JWB property. So I think it's always good just to go through kind of the nuts and bolts of it.
I agree.
Let's kind of zoom in to the left-hand side there. Yeah, kind of where you're at right there. Because that's the place where you're able to see sort of all of the real numbers that then are used to determine that 10.74% return on investment. So this is at 8824 Jasper Avenue in Arlington. This is an area that we have built literally hundreds of new construction rental properties. This area in Arlington was actually the birthplace of the build to rent phenomenon. In 2011, we bought about 45 lots and built our first new construction homes that became build to rent rental properties for our clients. And in 2013, we were recognized on the front page of the Wall Street Journal because of this development. And now, years later, now 2020, all of the big players are in build to rent. So this is actually like ground zero of build to rent, which is pretty cool.
That is cool.
Purchase price there of $199, right in line with our normal pricing here. What you're looking for when you're buying a rental property, you should be looking for a market that has below the median home price for the overall country, right? So you want to go below the U.S. median home price, and Jacksonville has that, right? Our median home price is about $250. The U.S. median home price is a little bit more than that. It was about $260, $265 last time I looked. Now, in that market, once you identify Jacksonville, let's say as a market, you then, out of that market, you want to be in neighborhoods that have below the median home price for that market, right? So if the median home price in Jacksonville is about $250, our typical pricing is going to be between $160,000 and $200,000. And that's that below middle income type of a neighborhood, which is perfect for cash flow. All right. We should talk a little bit more about neighborhoods, actually. I've been getting some feedback. Some folks have been talking about, they see new construction as a house, and then, they want to know about the rest of the neighborhood. And it's really important to have perspective when you're buying rental properties. In any asset class, there is no perfect asset class out there. There have to be things that you want, that you want to get, that are important to you, and you have to be willing to give up some things, right? In rental properties, right? What are the things that we love? What's the number one rule of rental properties?
Cash flow.
Pablo? We love positive cash flow, right? We want to make this easy. That's why you have a team like JWB to handle it for you. We want long-term growth and appreciation, right? We want these things. In order to get those things, you can't just go to any neighborhood out there, right? If you don't listen to what I'm saying and you go to markets or neighborhoods within those markets that are above the median house price, what you're going to walk into is a negative cash flow situation. So what we do as investors is we prioritize positive monthly cash flow over maybe being in a neighborhood that isn't, call it, the most affluent neighborhood, right? We could put evaluations together with neighborhoods and properties that look fantastic, that are on the beach, right? We were running on the beach today, weren't we, Pablo, this morning?
We were
right?
running on the beach today. Yeah.
I'm sure I could find you a rental property around that neighborhood that we're in that would look really nice and have the beach in the background. But you know what wouldn't look really nice?
The cash flow.
the cash flow. You'd go cash flow negative. And the number one rule of investing in rental properties is positive cash flow. So in order to do that, you have to be willing to understand that you're investing in neighborhoods that have low prices and high rents. Those are neighborhoods where a lot of people rent. It is unrealistic to think that you're going to be in a neighborhood that's the most affluent neighborhood if you're in a neighborhood with low prices and high rents where there's a lot of renters. And if this is the right model for you, you just have to be willing to accept that it's going to be in a neighborhood that's below middle income. Is that neighborhood going to have, some houses around there that lawns aren't taken care of? Will you see some people parking cars on the lawns every once in a while? Will you see a boarded up house every single time or every once in a while? Yeah, absolutely. You will. Will you see some of the neighborhoods that we're in, we're redeveloping. There used to be mobile homes and trailers in those neighborhoods. Will you see some mobile homes and trailers in some of the neighborhoods you look at if you want to buy a cash flow positive asset? Absolutely. And and if this is the right asset for you, you got to look at the positive cash flow and the ability to grow long term and a team to handle it and say that, well, that's more important to me. And just walk in with both eyes wide open and know that it might not be a neighborhood that you want to live in yourself. And it's got to be okay. So some people, want the best of all worlds. And it's just not realistic. No investment out there is realistic to have the best of everything. And this is just something that if it's okay with you, it's going to work out great. If it's not, if you got to look at that house and say, this is a place that I would want to rent myself, this asset class, it's probably not going to work for you unless you want to go negative cash flow.
Yeah, that makes sense, man. And listen, I'm going to get into questions because we got a bunch of questions coming in. They're really good questions. And I know that you got to get going at 1:15 today. So Mike Foster asks, on the 3 property example spreadsheets available at the JWB website, the down payment used for each property is 25%, not 20%. Is that because JWB's trusted lenders require 25% on their conventional loan?
That's a great question. No, it's not because it's required. You can put 20 or 25% down. You can even put more down if you really want to. But it really comes back to JWB's conservative nature. If we were to put 20% on those evaluations, it would limit your initial investment and it would actually juice your expected returns up. Your returns would be higher than 10.74% if we did that. And, we just care a lot about delivering on the returns that you see in the evaluation. So we consciously make the decision to somewhat suppress our returns on investment by putting 25% down in the interest of making sure that you're set up for success, that our service team is going to be taking care of you over the long run, that, everybody knows that this is something that we're going to be able to hit, and that you're pleasantly surprised if you decide to put 20% down, and that's the right thing based on, the conversations with our team, as we put the plan together, then it's only going to go up from there. And I think everybody wins that way.
Makes sense. Core values at JWB, under promise, over deliver. So just living your core values. And I love it. You are going to gobble up this question. So our boy, Jake Hargrove asks, shorthand evaluation, shouldn't you be looking for rent for 1% of purchase price? Nice to see that you can still cash flow with less than that.
Jake, I love that question. The 1% rule. I did a walk and talk on that in the group not too long ago, because I think this 1% rule is something that can really kind of hurt investors making decisions. What Jake's referencing is this, really easy way to evaluate for some folks as to when they should be buying a rental property. And the thought is, for every if your property sells for $100,000, you should get 1% of that for rents. You should get $1,000 for a $100,000 property. And so this 1% rule basically is a very easy way to calculate it. But where you hear this more often than not is in forums where there's a lot of active investors out there. Because the state of the market today is one in where if you are going to find properties at the 1% rule, you have to be an active investor, right? If you were investing in 2009 or 2010, when the market had just dropped 35% for pricing, could you have found the 1% rule buying as a client, buying at market value? Yeah, you could have, but that's not real anymore. And so what some people do now is they say, oh, geez, I need to find the 1% rule in order for this to be a good deal. It's not really the way it is, right? It's positive cash flow is the rule, right? And what this leads people to do sometimes is they get so focused on this 1% rule that there's other markets out there that have better cash flow numbers than Jacksonville. It's still tough to get to the 1% rule, but you might get closer in markets like Cleveland or Kansas City or maybe even Birmingham, right? Some of these low priced markets that have good rent to price ratios. And those are great cash flow markets. But what they're giving up is long-term growth. If you actually look at the long-term growth in a market like Jacksonville, and I compared it to the other 5 most comparable markets, cash flow markets out there, compared it to Dallas, which is still a growth market, compared it to Birmingham, Kansas City, Cleveland, one other one. It's the top 5. Memphis. Jacksonville's appreciation since 1991 is 34% more on average than those comparable cash flow markets out there. So again, this 1% rule, it's not realistic in a market like Jacksonville. I don't know how close you can get to it in some of these other markets, but even if you can, what you're getting is more cash flow today, a higher return on your investment from cash flow, but you're giving up a ton of long-term growth. And our mentality is you want the best of both worlds. You want positive cash flow, which you can get at JWB in Jacksonville. And you also want to be in a market that's going to get you long-term growth, that's going to appreciate a little bit over 4% when you hold on for a market cycle. And if you look at the best return on investment after a 10 or a 20-year hold, and you compare, maybe you bought it in Kansas City and you got closer to the 1% rule, or maybe you bought it in Jacksonville and you got less cash flow, but a lot more long-term growth, your overall return on investment would be much higher in Jacksonville, because it's going to affect a lot more. So I'm not a huge fan of the 1% rule. I think it does, for a lot of folks, it does more damage than good, because it keeps the cash flow blinders on people and they don't look to the other profit centers.
There you go, Jake. Now you know. Just FYI, Jake is from Memphis, so
Nice.
Sorry, buddy. You should be from Jacksonville. So all right, I'm gonna go. We still have good ones here in the chat, but I want to get to some of the stuff that was asked on Tuesday, so that we honor that. Marilyn Cotterman asked on Tuesday, if you only have 55 more homes left to sale/lease, it sounds like you'll be needing more homes soon. What is the rate of new construction homes being built?
A really good question. Opportunity for me to clarify. So on Tuesday, when we were talking about our company update, I shared how fantastic our leasing team is doing. And one of the stats that I gave is, we manage over 3,500 homes here in Jacksonville. That's the total number of homes that we manage. We only have 55 that are available for rent at this moment. Over 98% occupancy. I mean, it's a fantastic number. What it does is communicate to all of our owners that things are leasing really quickly, and you're just in a great spot, because we have to lease well, we have to rent homes well, and we have to collect rent well in order for this whole model to work. Now, that 55 number is not the number of homes that JWB has in inventory, right? Many of those homes, of those 55, are already owned by clients, right? Resident may have moved out. Now we're putting a new resident in, it's on the market for that. So that 55 number is not the number of homes that JWB has to sell. And we did a walk and talk on this not too long ago, as well as talking about the runway of inventory for clients. JWB, we saw this inventory crunch coming many years ago. And if for those, maybe Jake knows, in Memphis, I know a lot of turnkey providers in Memphis have an inventory crunch. They can't find enough inventory to supply for their clientele. And we don't have that issue here in Jacksonville. We're able to supply enough, and a lot of that is through new construction. So Marilyn, to answer your question, we don't have an inventory crunch. We always have enough homes for our clients to purchase. There has never been a single time when a client has ever come to JWB and we didn't have enough inventory for them. Right now, I think we have 20 or maybe 25 homes available for purchase for our clients. We build about 400 each year. And so, call that, what's that? I think right now we're building about 25, 30 a week. 25 or 30 a month. Yeah, that's what we're doing right now. Kind of going off the top of my head here, but that's in the pipeline for future sales. And so, and we have additional lots that we haven't even built out. And so what we do is buy up a whole bunch of land, buy more land because right now is the time to acquire it. When inventory demands come down, we're looking a year into the future and say, how much inventory are we going to need? We release the number of homes to be built that we need to supply our demand for our clients. And then clients never have to worry about wanting to buy an asset and then having to wait or it not being there for JWB. So no inventory concerns whatsoever there.
There you go, man. You got that factory line of inventory ready to go for everybody. By the way, Jake says he's going to make it to Jacksonville one of these days and take one of these morning jogs with us when this virus stuff is over, which
I love it.
You're welcome to come, Jake. Just letting you know, you got to run at least a 14-minute mile. So Lee Pham asks, what's your take on cash out refi of the rentals to buy more properties? Why cash out refi interest rate is higher than purchase interest rate? So I guess that is, why is the cash out refi interest rate higher than a purchase interest rate? And what's your take on those?
So first question, what's my take on looking at refinancing as a way to pull cash out and really as a way to decrease your interest rate typically? I'll get to the second question in a second, but a lot of people have bought 5 years ago or maybe 10 years ago, and your interest rates are a lot higher then than they are now. So it's very hard to find somebody who has an interest rate that's not higher, because right now Freddie Mac has been tracking interest rates since they started in 1971. There's never been lower interest rates than we have right now. JWB has never put out an expectation of 4% interest rates on our evaluations in the history of JWB. So overall, I think it's something to sit down with my team and make sure we build the plan out. I hate giving kind of one size fits all answers to these types of questions, but generally speaking, I think it's a great time to explore it, right? You could be looking at this, and some folks who bought 5 years ago, your properties have gone up in value. And, if you put 20% down 5 years ago and your properties have gone up in value, there might be a way for you to be able to pull out dollars that may help you buy more properties, right? If your ultimate goal is to get to 10 properties and you're at 5 properties right now, but you have some equity there, you could tap into that and turn that maybe into 6 or 7 or 8 properties or whatever the number is. And the cool thing is that you're getting it at historically low interest rates that are there again for you for 30 years. So I think it's the best time in history in my mind to look at refinancing. Doesn't mean it's right for everybody. Your family situation, your personal financial situation, we got to sit down and look at it. But I think it is a great thing to do. And a lot of clients are doing it. The second question about why would a cash out refinance rate be higher than a purchase rate? It may be slightly higher. It's still going to be super low. I mean, you're talking in the 4s, definitely. And I'm not 100% clear on if it's higher for a cash out or not, but I'm just giving you my general feel. There's a little bit more risk to a bank when they know that you're taking cash out, right? When you're going to buy a property, they know that you're bringing money to them. You're putting 20% down or 25% down of your own hard-earned money. And to them, that makes them feel better. When you go and you get a cash out refinance, that's a new bank cashing out a previous bank's loan. And that new bank runs the numbers and say, okay, well, you're going to be able to pull out $20,000 from this. That's a little bit more risky to a bank. So I would imagine typically that maybe a little bit higher, but overall, comparing where we're at with interest rates right now, still an amazing opportunity. And the other thing to note is that you don't necessarily have to take cash out, right? I mean, if you bought properties 5 years ago and your interest rates were, 6%, you might want to consider and run the numbers, see how long you're going to be owning these assets. But it might make sense just to refinance that asset from 6% down to 4% and drop your payments, right? So definitely, I would encourage everybody to be looking at their interest rates, to be looking at the mortgages they have right now, talking to your team here at JWB or whichever professionals you trust, because there's typically some money to be saved and better returns to be had for most investors out there by refinancing.
All right, man. Yeah, I'm hearing the advantage of these historically low interest rates all over the equation, right? Like, and it kind of has this like overall umbrella effect on what your options are specifically right now, or for however long they're going to be this low. So it does seem like our conversation this morning on our run, right? Like I was going real hard at you picking your brain on like, dude, I need to take action right now. So, you know, I do see this like inherent value of going to chat with JWB at this moment to just dial that in for you, whether it's that refi or whatever it is, right? Like I'm doing it, right? Like I have a call scheduled and it is what it is. So I'm just,
That's awesome.
yeah.
And that's why we're there, not only for new
Yeah.
potential clients, we're there for current clients. These are the conversations we get to have every month with our current clients. And if something's come up and, you know, your appointment's 2 weeks off from now and you're a current client, reach out to our team. Your portfolio manager loves to have these types of conversations. And even if that doesn't mean that you're going to be buying again, right? We're here to serve. We're here to be a resource for you. And we'll put you in touch with a lender who may be able to really reduce your payments. And, you know, we love that because that increases your return on investment. When we increase your return on investment, you're going to be happier. Eventually, you're going to come back and buy more houses with us and tell your friends and family about us.
Cool. So Gigi or Gigi Scaria, Gigi, I'm sorry, or Gigi, I'm sorry if I'm butchering your first name and last name there. My apologies. I really do try. So I'm just going to go with Gigi Scaria. Can you discuss about how is rental management and rental fees? And if you want, I'm going to pop up the case study here.
Yeah, absolutely. I think that'd be great. Let's use that as the backdrop here. So
do you want me to go to the other cash analysis tab, or is this good?
Yeah, let's go to the cash analysis tab. It's a little bit more broken up there. So, you know what? Let's go to the analysis conventional financing. Yeah, there you go.
Where do you want me?
Just kind of zoomed in like you did on just the previous tab there. We'll
To
focus
where?
in on the left side. Yeah, we'll do like a typical month right there. Perfect.
Okay, cool.
All right. So we're talking about property management fees. You know, property management fees are not created equal across all property management companies. I did another walk and talk on this on Monday, actually. It was the pitfalls of property management. And, you know, a couple of those were related to how their fee structure works. You know, goals are typically not aligned for most property management companies with you as an owner. And I say that confidently because if you look at how they make the decision to sign leases, it's not congruent with the best path for success as an owner of rental properties, right? As an owner of rental properties, you're going to have the most success if you're happy, if your tenant is happy and they stay in your home for a long period of time. Long-term tenant stays is the greatest correlation to your success as a rental property investor. So you should be asking yourself, for most property management companies, if they know this, which they should, why are they only signing 1-year leases? You know, unfortunately, a lot of it has to do with how their finances work, the way that their business makes money, and their goals are just not in line. So a typical property management company actually makes more money the more often they put a new resident in your home. And it's because a huge majority of their fees and what they earn and their best dollar per hour actually is leasing your home out, which stinks for you because every time you lease your home out, what happened, Pablo?
You got replacement costs.
You got replacement costs. Absolutely. You got expensive ones too, right? That means that somebody just left, which means that you got to put a couple $1,000s into the property to get it back into rental shape. You got a couple of months of vacancy cost. You know, you got your mortgage payments still to make. You're not receiving rental income because it takes a little bit of time to get a new resident in place and have them move in. And then the big one is tenant placement fees. Tenant placement fees are expensive, right? That's a big cost to you. That is the best dollar per hour activity for a property management company. So at the core of it, there's a lot of reasons, but at the core of it, that's why you don't see typical property management companies sign anything longer than a 1-year lease. If you ask them to do that, you're going to be asking them to work 2 times, 3 times as hard and to make half as much money or a third as much money, and you're just not going to see it. So that begs the question, why does JWB sign long-term leases? Well, the majority of our income comes from home sales, not from property management fees. Kind of goes back to what I was just saying, right? If we can increase your return on investment, history shows that you're going to be happy. You're going to complete your buying plan with us, and then you're going to tell your friends and family about us. And so we're going to make more money in the long run, the better your returns are. And one of the best ways that we can do that is to not have a tenant placement fee every year. So that's why we sign 2- and 3-year leases, but typical property management companies do not. They don't have that same incentive that we have, and their goals aren't aligned with you as an owner. So I say that leading into what the fees are. So let's look at this here. When you look at, let's go to kind of year one here. And if you want to put your cursor on that, column F, year one there. All right. Look at line 28 there. That's $1,425. Yeah, right there. So this is another thing when you're comparing evaluations across different turnkey providers. Many times they will not include the full tenant placement fee when they're estimating your return on investment. It's an easy thing for them to not put on there, which has a huge impact on your returns. Pablo, for fun, just delete that 1425 cell. All right, now go all the way down to the bottom. See that 13.34% return on investment? I just made 3% gain on the estimated return on investment. Do you think more people are interested when I show them a 13% return on investment versus a 10.74% return on investment?
I would venture a guess, yes.
Absolutely. This is one of the tips and tricks and little things that other turnkey property management companies do, which ultimately set up poor expectations. Because Pablo, guess what happens when we rent your property out in year one?
There's so many guesses. I have so many guesses. First of all, I feel like I have arrived.
I was going to see how many times until I can stump you. Well, from a tenant placement fee perspective, you get charged a tenant placement fee. It happens in year one, right? Unless we don't rent your property out, which has never happened. Okay. You're going to see it. So you should put it on there.
My first guess was going to be that I was going to be much more popular with my wife, but continue.
You're always the most popular man in the room. Let's be serious. All right. So there's your tenant placement fee. It's equal to 1 month's rent. You may see that anywhere from a half a month's rent to a full month's rent. But everywhere else, I won't say everywhere, most other places and most turnkey companies and most standalone property management companies are only going to sign 1-year leases. Right? And so if you run the numbers, even if you see a half month's rent for tenant placement, but you only sign a 1-year lease, you're losing. You're losing because if you sign a lease that's a 2 or a 3-year lease and they end up staying 4+ years, almost 5 years like they do for JWB, you end up paying less even though you pay a full month's tenant placement. So that's a little bit about the tenant placement fee there. Make sense?
That makes sense.
Cool. The other fees that you'll see for JWB are your property management fees, which is the row just above $1,710 over a year. That's just 10% of the gross rents that are collected. That is what we earn to do everything we do for your rental properties. It's to build the relationship with the resident. It's to collect the rent. It's if there are any maintenance issues, we would be handling that for you. You never have to lift a finger. Your resident's never going to know your name or your phone number. We control that relationship for you and then just give you the passive income. So that's what goes along with that. And then the only fee that we, of course, disclose, but you don't see it here, is your lease renewal fees. So a lease renewal, again, is one of the best things that we can do as a property management company to increase your return on investment. Right? We talked about how painful it is when you have a tenant move out. Right? We talked about those major fees that you get hit with from vacancy costs, from tenant placement fee, from putting a couple $1,000s of work back into the house to get it ready to rent. Well, if we renew your lease, Pablo, do you think you have any of those fees? No, you're excited. That's literally putting thousands of dollars back into your property. And so, and the lease renewal fees are really inexpensive as well. We only charge $200 for every year that we renew. So we renew them for 1 year, it's $200. If it's a 3-year lease that we renew, it's $600 and a huge savings for you overall.
Awesome. That pretty good all-encompassing property management breakdown there, Greg. I applaud you. And I know you got to get going, but I got a question in here that I think is in your best interest to answer in public, right? So Matthew Prenat asks, can you comment on how you differentiate from the other build-to-rent providers in your area? By the numbers alone, price to rent ratio, they seem to be a little more competitive.
That's great. It's wonderful. It's like, it's awesome to know that there are other folks that have jumped on to build to rent, right? For a long time, people called us crazy. They didn't know what we were doing. It's like, you can't build a house and rent it out. That's weird, right? So yes, there are others now nationally that are doing build to rent. The big guys are in, and even here locally, we have some folks. They do it generally on a smaller scale. One thing I would really encourage you to look at that is a big differentiator is if their property management is in-house. I know who you're speaking of. It's not in-house. It's a big deal. And, it comes back to investing for a passive approach. If you want one phone number to call for all of the good things, all of the bad things that happen with your property, if you want one set of expectations, it's important to have property management in-house. It's important to have that under one roof. The other thing I would look at is the evaluations. Based on what we talked about today, I would really compare the evaluations that you're seeing elsewhere. Generally speaking, there's a lot of things that other folks don't include. So that might be a couple of differentiators there. But at the end of the day, the reason why people come to JWB, it's the team. It's the structure of everything being under one roof. That's the great differentiator for us. And that's also, in my mind, that's the most important part of the decision. But that's also the thing that nobody can replicate. And so, yeah, I think that's it right there.
Makes a lot of sense, man. Being on the investor only call on Monday, it was very apparent to me that JWB has, obviously the team has been very apparent to me forever. I never shut up about the culture and leadership and all the stuff that's happening because I'm fascinated by it. But the idea that your property manager, your portfolio manager is like your Alexa for investment decisions and wealth building decisions, right? Like having that one number that not only is gonna, fix the toilet that's broken without you even having to worry about it, and B, can like verify if your Northwestern Mutual guy is telling you that you should buy life insurance over another rental income property, I think is supremely valuable. Like that just was totally on display on Monday's call for me. So
and it's a team that cares. It comes back to that. It's also a team that knows that they're going to be held accountable for what they say on the front end, right? It's that the reporting that we have goes to substantiate those returns. Part of the reason you hear me say, well, why do we put 25% down versus 20% down on the evaluation? Why do we include the tenant placement fee when others don't? Why do we do all this that suppress our return on investment? It's because at the end of the day, what we're going to be able to do is to show up every single month, report on what did we tell you your returns were going to be and how did we do? And there's no other turnkey company that I'm aware of in the entire country or the entire world for that matter that has this client ROI report that compares estimates at the time of purchase to actuals, and it's done for you every single month. So at the core of it, we're held accountable and we want that. So that's a big difference.
All right, buddy. I'm going to get you out of here. I know you got another meeting. Gigi had a question about how she can do a JWB tour. If I'm not mistaken, you got to be a client in order to do a JWB tour. And right now during coronavirus, that's on pause, right?
Couple things. Yes, it's on pause. We're not flying clients in like we want to because of obvious reasons, but there's a tour for every new client who is brought on. So what we do is we do it virtually. It's through the process of acquiring your properties. We do it with our sales team. We give you an overview of the neighborhoods of Jacksonville, all that good stuff. So that's a part of our normal process. So like most things right now, most people are not traveling to conferences. We figured out a way to do it virtually. That's what we do here. So we would encourage you to go to chatwithjwb.com, set up a time to speak with our team, and that'll be there for you when you're ready.
Correct. So you knocked that part out for me. Encourage everybody to go to chatwithjwb.com and set up a call. I also want to encourage people. We have a bunch more questions here. A lot of these questions would be really well suited for the Facebook group, right? Like we got this awesome Facebook group. It's our like little cool club. There's 50. I can't even call it the little cool club anymore because it's 1,500 people now. But it's a place to network. It's a place to ask questions. Gregg goes live in there every single morning, and he hosts a watch party in the evenings after the show. So just more access to Gregg if you want to hear it from him, more access to other people that do business with JWB. You can go to jwbfacebookgroup.com, and that'll link you straight in. You just opt in, I'll approve you, and boom, we're buddies. So I want to encourage everybody to do that. Go to chatwithjwb.com if you want to take advantage of these like crazy interest rates and all the stuff that's happening right now that is truly, truly unique. And also, if you just want to get more of a evaluation on rental income properties, go to jwbwebclass.com. And as always, Thursdays. We love Thursdays. This is a very like buddy feeling that we have on Thursdays because we don't have the guest. We don't have the pressure of, you know, our Tuesday shows very much are about highlighting the guests and getting you as much value out of them as possible. But here, Gregg and I can go back and forth and really get into the questions. I'm keeping track of all the other questions, sending it to the team. We'll keep it on a running list for next time. But thank you, everybody, for being with us. And Gregg, I'm going to give you the last word as always.
Yeah, just echo that the group is a great place. I've seen some folks just post their question right in the group. I'm usually able to get back to you very quickly. But even if I can't, there's other really well-respected, savvy investors that have been in your shoes before, and they can answer your questions. So I think it'd be great. I mean, if there's, you know, if I'm asking for things to maybe have a little bit more interaction in the group from other folks, other clients, other people who have questions, we would love that. So I would encourage you to do that first and foremost. But we're always going to be here for you Tuesdays and Thursdays, 12:30. We love you guys. We appreciate you guys being here.
Tuesday. Who do we got coming up Tuesday, man?
We got Keith Weinhold.
Your boy.
My buddy. Yeah, Keith is one of the most well-respected real estate authorities. You know, he runs an incredible podcast called the Get Rich Education Podcast. Keith and I struck up a relationship, I don't know, maybe 4 years ago. And, you know, he's a great dude. He's a great dude with a wealth of knowledge and something that you guys, we're going to be talking specifically about how to choose the right real estate markets. Bringing on somebody who has invested in other places than here in Jacksonville. Obviously loves the Jacksonville market, but I think it's great to get an outsider's perspective, somebody who's invested literally millions of dollars and helped clients invest millions of dollars, and how he thinks about different markets as well. So should be an awesome show.
See you all on Tuesday and in the Facebook group in the meantime. Have a great rest of your week, everybody.
See ya.